Hello, everyone, and welcome to a market update. Today is Friday, what is Friday? The 10th of February. Unbelievable that it's already almost the middle of Feb. Happy Valentine's Day to everyone out there for next week. Hope you have some great plans with someone you care about in your life. Doesn't have to be a romantic partner. It could just be a celebration of love of family members. Before I get all gushy and too far down that track, top three things today are going to be rates, earnings, and recession. I think this will be a fairly quick update, which is why I've just got my camera on. It's just you and me here in my office today, and I'll keep it pretty tight and pretty quick. I'm going to be just reinforcing things that I've been saying for the last few updates. Number one on rates. We got two rate rises in the last 2 weeks, one in the US and one in Australia. We've also had further confirmation from the US Federal Reserve and Jerome Powell that rates are going to continue to rise and they're probably going to stay elevated for some time. We've also had the RBA in Australia coming out and basically saying prepare for some tough economic times ahead. The central banks are telegraphing for us right now that things are going to get worse. And that is off the back of the cost of capital rising. And this is kind of like being the frog in the boiling water, or the pot analogy that's the heat's turned on and it goes to a boil. And I think there's a lot of the world, particularly the Western world and the developed world, that is so indebted and is not seeing wage increases as an example, and seeing inflationary pressures. The cost of living is higher. And now, of course, we have the great mortgage reset coming in June of this year. And every month we get closer and closer to that, more and more of the fixed rates that were taken up during the COVID crisis because they were so bloody good, the 1.9s and the 2.09s and the 2.1s and so forth that people took out during that period of time, they're starting to reset. And there's an increase in mortgage pressure out there. There's an increase in, or sorry, I should say a decrease in disposable income. And the big trap door is going to open in June of this year when 45% of Australian mortgages are going to reset. This is a very serious issue, and it's getting very little airtime. I think probably because, I don't know, the mainstream media probably doesn't want to spook people. The real estate establishment wants to keep people thinking that now's a good time to buy a house. It is not. It is not a good time to buy any levered asset because the cost of capital is rising. So, and I've said this many times now. Hopefully, you're paying attention and listening to that commentary, because if you're not, you're just putting yourself at risk down the track of having some serious cash flow problems. Furthermore, I think that you are giving up the opportunity to take advantage of other people's misfortune and pain, which I do believe is coming later this year. May not really fully sort of articulate or fully happen in the economy. There's another word I'm looking for there, but I can't. Manifest. There we go. Manifest in the economy until early 2024, because everything happens on a lag when it comes to interest rate rises. Interest rates have risen a lot. We've started to see more and more pain now creeping in. And that measurement of pain that I'm talking about specifically is mortgage delinquencies or arrears. That number is ticking up slowly. So it's going in the wrong direction, basically, in Australia. So we will continue. I think we'll have another rate rise in March. I have no doubt the RBA is going to have to tick that up. Be watching closely to see what the next inflation print here is in Australia, because if inflation doesn't start coming down meaningfully, and I mean like doesn't have a 7 in front of it, I think the RBA they're just going to be forced to keep raising interest rates. So we're in a bit of a perfect storm here, where we have a number of things happening in the economy that do not bode well for the next year. It's the reason we're going to be in quad 4 for at least the next 2 quarters. So that's rates. Please rewind this, watch it again if you're unclear on what I'm saying about interest rates and the cost of capital. Hopefully I'm being very, very clear to you about that. Number 2, earnings. So corporate earnings reports continue to be released. This is sort of the reporting season in the U.S., or one of them anyway, quarterly reporting periods. And it's not good. So if you strip out energy, which had a massive, the oil price went up huge last year. So of course the energy complex broadly is going to report really positive earnings. You strip that out, and you strip out a little bit of the industrial stuff, which has also kind of had some pretty good earnings. Everything else is negative and is trending down. And energy is going to follow, because energy prices are going to collapse simply because, or oil prices will likely collapse simply because demand is being destroyed. People can't afford to buy petrol because of the high price, but also because of all the other inflationary pressures. So plus, when you go into a recessionary environment, the demand for things like energy go down. So energy is not a quad 4 asset. Basically, it's something you want to avoid in quad 4. We don't own any energy at this point. But back to earnings. So corporate earnings are on the decline, and there, I think, are going to be more downside surprises ahead, where companies are guiding lower. During COVID, and I'll just quickly cover this, but during COVID, because of the massive increase in GDP that we had and all the spending that took place, it skewed, or has distorted a lot of the earnings that companies had. So they went from sort of really bad earnings to really great earnings, and now the comparison period that a lot of Wall Street analysts and analysts are using to project earnings forward are flawed because they're using the wrong input. A great example of this is the retail sector in the U.S., which typically earns around 150, 160, give or take, let's say, 5 or 10% either way, $1 billion of income every year in the retail space, and it ticks up 1 or 2% every year. It's a pretty slow burn. It's pretty stable industry. After the economy opened up, that shot up. I think I talked about this many market updates ago, but that those earnings shot up to something like $275 billion or $300 billion. It was a huge increase because of all the pent up demand, because people couldn't get out, they couldn't go shopping, all of that stuff, right? And stupidly, this is the number that analysts are using to base forward projections on. Now, it's wrong, because the industry, the retail sector, I'm talking, apparel and the such like, it has already shown that it's come back down to that longer term, or that sort of that average of 150 to 160 billion dollars a year. So this is bad. Anyway, the point I'm trying to make is I'm singling out a sector that is going to be under tremendous pressure over the course of the next 6 to 12 months, because people are tapped out, spending is dropping, earnings will fall. So that's a sector that we are sort of avoiding at all costs. But anyway, earnings are going to be re-rated to the downside. This is bad. You can't have stock market valuations rising when the cost of capital is rising. That impacts earnings because, of course, debt service costs more for corporates. And number two, their earnings are falling. And with falling earnings, it means there's less cash flow. So there's a lot of companies, a lot of profitless tech companies and stuff that are out there that are they're burning cash left, right, and center, and are not going to grow because their business models are flawed to begin with, but the economy is shrinking, so they can't grow. And this is going to be true for a lot of industries across the board. Finally, that leads into the point number 3, which is recession. If we're not already in a recession, I'd be surprised. But if we aren't, we're going to be by the middle of this year. Now, we won't know this, like absolutely know it, until probably late this year or early 2024, when they look back and report on the numbers from previous quarters. But we'll see it out there. There'll be bankruptcies. There'll be downsizing going on. There'll be just other commentary about consumer confidence and business confidence, which are all sliding, by the way. So recessions are times where the economy cleanses itself and flushes out all the irrational exuberance and other bad things that happen in previous periods. And we're headed in that direction. So we are headed in the direction of I think, a serious recession. The response from the central bank, of course, will be to decrease interest rates. The question at that point is going to be, how big will the cuts be, and how many cuts will they make? Because one of the things, and in particular, this will be true of the U.S., maybe not so much for Australia, but potentially Australia as well, is that if they start slowing or cutting too soon, they run the risk of reinflating or reigniting the inflation problem. This happened back in the 70s, just prior to when Paul Volcker took over the Fed. For those of you that are any student of economics or economic history, you know that Paul Volcker came after a guy named Arthur Burns, who ran the central bank in the U.S. And Arthur Burns mistakenly began cutting interest rates. This was around the time that U.S. interest rates peaked around 14%, because it looked like inflation had started to moderate, and he started cutting too quick. And what happened was he cut rates down, but inflation actually spiked and went above the previous read that they were so concerned about. I don't remember the exact level, but I think inflation went from like 14%, and then came down a little bit, maybe to 10 or 9 or 8 or something, and then shot back up to like 14 or 15% or something ludicrous like that. And that is what caused the central bank to have to then, when Paul Volcker came in to the Fed, had to raise rates to, like the 17, 18% rates that we saw. So I'm sure that in the institutional memory of these institutions like the Fed and the RBA, we probably didn't have a central bank back then. I can't remember how long the RBA has been around. Nevertheless, the point really is that Jerome Powell is a student of Fed history, and he doesn't want to be the guy that started to cut rates too soon and saw inflation ramp back up. So with that psychology in mind, what I'm telling you is that we should not be expecting the cost of capital regime, as I've said before, I believe, has shifted to a more moderate, like this is where the long-term averages are in terms of cost of capital. We're back into that space between, say, 4 and 6% average interest rates on a variable rate for a home loan, as an example, as the cost of capital. We're headed back into that regime, and we'll probably stay there. And that's going to take liquidity out of the market. It's going to mean that people can't service as much debt as they were able to when rates were, 3% for a home mortgage. So all the dynamics, basically what this means is all the dynamics in the market for debt are going to change, and they're going to have an effect on asset prices. So I would not be expecting to see any meaningful appreciation in asset prices, specifically property prices I'm talking about in Australia, for the foreseeable future. Because, again, the cost of capital is too high. People can't afford to borrow as much. And anecdotally, I was running some property searches yesterday on properties just around the Northern Beaches area here, my suburb of Belrose and another suburb nearby. And the market data showed that the price of property in Belrose alone had adjusted 20% to the negative. So it's 20% down in the last 12 months. So that's pretty meaningful. And I think the average for Sydney was like 12.5% or something like that. So obviously there's going to be suburbs that maybe had a small positive gain, and suburbs that have not fallen as much as, say, 20% or as 12%. And then there might be some suburbs that have had even bigger declines. But nevertheless, the point is that property values are going to be going down, and they are going to continue trending down, I think, for some time. I'm not saying there's going to be a crash or anything like that, but all you have to do, and this is not hard. This exercise in figuring out this problem isn't difficult. If interest rates rise, and I've seen some really stupid people, I'm going to call them stupid because they are stupid, property spruikers out there on YouTube saying, or running ads saying, high interest rates don't crash the property market. Well, yes, they do. They don't crash the property market, but they absolutely are a factor in price appreciation, or whether we see a decline in property prices. And just so you know, this person that I'm not going to say their name, but this person I was watching in this ad was then saying, let's look at a 20-year period of time. Well, of course, over a 20-year period of time, it's unlikely that you're not going to see an extended crash over a 20-year period. These things happen in 1, 2, maybe 3-year sort of bursts, where you might have a decline, then very slight or flat appreciation, and then we return back to having a lot of appreciation, because the cycle turns and interest rates get cut, and that's what stimulates it again. It's really not a difficult thing to understand. So I'm going to wrap it up there. Hopefully, again, the message that is coming through loud and clear in a lot of these market updates is patience, especially from an investment point of view, because there is a lot of volatility in the market right now. There are some other things, and maybe I'll talk about this in another market update next week, but there's some very interesting things going on with some options trading and some other stuff that are clearly they're trying to manipulate the market. It's the newest bubble in the markets, the 0 day to options expiration, 0 day to expiration options, I should say. Just astounding, really, watching some of this stuff going on. But that sort of speculation and just outright manipulation of markets tends to end badly. So, I mean, I'm not, again, not calling for a market crash or anything like that, but we're absolutely in a bear market. We're having a bear market. We've had a bear market bounce, and I think that's now reversed or started its reversal. And going forward, it's a quad 4 asset portfolio that I'm putting on. That is, just quickly so you know, that is precious metals, that is bonds, and some other defensives like utilities, and there'll be some other things, low beta stuff and whatever. But primarily it's going to be the precious metals and the precious metals complex. So gold miners, silver miners, gold junior and silver junior miners. All of this is going to, by the way, all of this is going to be the spark. So we got to go through this to get to the other side, which is a quad 1 or a quad 2, but likely it's a quad 1 scenario. And that's where portfolio gets reallocated to growth stocks, to tech, to everything that grows, and that's where you get the juice. So for now, it's a case of being patient. I'm allocating capital to make money in a quad 4 environment, but it will be hard because a lot of that stuff it's not sexy. It isn't going to have a huge run per se. It could. I mean, gold could all of a sudden start to shoot up as soon as the Fed signals that interest rates need to be cut. I think we will see gold and silver in the precious metals complex have a fantastic run. Just don't know what it'll look like. Anyway, we'll get there when we get there. Have a fantastic weekend. And if you do want to schedule yourself in for an appointment in my email footer, if you've had a recent email from us, you can make an appointment booking. If you don't have that, just contact the lady, send her a quick email and say, hey, can you book me in for this time, or send me the link. She will be happy to do that. And I'll look forward to having a chat at some stage soon. Take care. Have a good weekend. Bye-bye.